No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about how to protect yourself in these very volatile times. This is one of those areas where I get calls, typically in particular with new clients coming in, wondering, are things going to get any worse, or do we think we're at the bottom? Is it safe to invest in the market right now? Concerns about income, inflation, prices going up, of course, food, gas, all this. All these things set up a situation that may have you concerned. How am I going to, in fact, protect myself in these volatile times? Going back, we've been talking about inflation, and as I was looking over some of the past shows and stuff that we've done over the last year, going back to, let's see, I think some articles from October and even July of last year, a year ago, where the Foundation for Economic Education talking at that time about inflation hitting a 13-year high. Nationwide inflation in October, this is from the Tennessean, talking about inflation trend jacks up prices and confidence slumps across Tennessee. And in another article, Paul Tudor Jones, he's a billionaire hedge fund manager, and he talked about, says inflation could be worse than feared, the biggest threat to markets and society. And that, again, you're talking back in October, so this isn't new that as I said, we've been talking about it for some time. And what it means when you see inflation going up, if your investments at the same time as we're seeing with this year to date, inflation the markets, and affected by inflation and the Federal Reserve, of course, raising interest rates. So what we've seen is the markets being down as well. And I was going back through some numbers here. Back in May, I was talking talking about this same program we're going to get into today, but with some updates. And one of the things that, going back to the beginning of May, so a couple of months ago, the market at that time, the bond market was down, right? 10%. Now that's bonds. Bonds are normally going to go up, or at least protect, hold on to your money while the stocks are down. Bonds are typically up, or at least, like I say, not falling at the same time. But what we're seeing this year is bonds are going down. Bonds have gone down 10% year to date. All right, and as bad as that sounds, we look at the market. So back and by the way, in May, a couple of months ago, bonds were down about 10. They're down about 10.3, so very similar. They haven't, they've pretty much, once it hit that low, it's held there over the last couple of months anyway. Whereas we see the S&P, on the other hand, back in May was down 13% year to date. It's now down 18%. And that's off of the lows. At one point, it was down 22%. The Russell 2000 down 17%, 17.6 back in May, is down 22% now. So again, these are the market, point being, the market is continuing to go down with the exception of this past week. So far, we'll see how today goes, but so far, the market this week has regained the S&P 3%. So as I said, it was down about 22, now down about 18. The Russell, the same thing, it was down about 26%. Right, and now down about 22. So we've seen, again, off of the lows, but still lower than what it was just 2 months ago. And in NASDAQ, this is of course, we were looking at a 22% low back in May. Now it's 26, and that's after a 1.5% recovery this past week. So that's, a 5% recovery this past week. So you're looking at a time when it was down almost 30%, or a little over 30%. When we see this type of volatility, and we're saying, I don't think the markets are at the bottom yet. So this is one of those areas you have to look at when it comes to your investments. How do you protect yourself, in particular to protect your income right, to not be affected. So when prices are going up, right, and your money, your value of your money is going down at the same time, and income is not going up as much as prices are going up, it squeezes you. What it means, you're going to have to start spending more of your dollars, right, to cover those same expenses. Now, one way that you can help protect, we've talked about annuities as an example. So an annuity can give you a steady source of income, not affected by the markets, or at least not negatively affected by the markets, yet potentially positively affected by the markets. In other words, when the markets are going down, your income is not going to be affected. It's not going to go down as well. But when the market goes up, then again, this depends on the annuity, but there are annuities out there that will give you additional return as you're getting income based on the market index. So as the market's going up, you can see your income go up as well, though when the market drops, your income is still protected, that base income that you have. So I'm going to explain more about how that works and some of the other benefits and features of annuities, and break it down for you a little bit about both the types of annuities, some good things that you want to look for in an annuity, and as well as some things you want to avoid. And by the way, if you have annuities now, and I know a good amount of people, a good high percentage, in fact, of retirees do, then that's one of those areas you want to be thinking the type of annuity you have. Is it a fixed annuity, a fixed index annuity, a variable annuity? All of those we're going to talk about, and how that what the pros and cons of each one are, and also give you an opportunity if you would like to get a comparison, if you will, of how your annuity and how long you've had it. Annuities have improved over the years as well. I've been working with annuities for about 30 years, and in that time I've seen a lot of improvements, tremendous improvements, and they've done well over those years. Occasionally you get those that don't do well, and that's what this is about as well, to help you avoid those. All right, so we're going to be, oh, by the way, one of the things to think in terms of when it comes to your investments, okay, we're just talking about inflation and the fact that we've been warning about that going back a year ago, that inflation was looking up. That's when, in fact, come to think of it, I think it's been longer than that. It's been almost a year, let's say, almost 2 years ago. So it's about 2 years ago that we started talking about inflation and being concerned about inflation, and that's when we started looking at things like Treasury notes that are what are called TIPS. So these are Treasury inflation protected securities, and safe investments that have a rider that can add money to your investment, to your the amount of money you have in those treasuries based on inflation. So we were looking at recommending those back then as to take a look at that. Another thing that we've been talking about, of course, has to do with the safe withdrawal rate. So when you see inflation going up at the rate it was, and we see the Fed, we know is going to have to act, and if they want to dampen down inflation, and they think the economy is strong enough, and they think they can go ahead and raise interest rates, which they have, of course. They've already done that, and we've seen mortgage rates, for instance, affected by that, almost double over what they were a year ago. So this is, these are some big changes in a relatively short amount of time. And now, what can you do to protect yourself? We're going to talk again about annuities, but here's something else to keep in mind. The other part of what we're trying to accomplish when we're looking at the effect of inflation and, of course, taxes, and how we can earn enough on our money to stay ahead of inflation and taxes over the long term. So I'm going to get into that a little bit with you. I want you to be thinking of another article that I shared with you. This has been about a year ago as well, and this was on the 4% rule, and this has to do with what's called safe withdrawal rates from your portfolio, from your investments. So and think how this works. If I need enough to grow my money to stay ahead of inflation and taxes, plus I'm looking to draw down 4%, I'm adding, right? I'm needing, at this time, just under normal circumstances, I need probably about 6%, between 5, 6 maybe, that I need to be making on my money to be able to make sure I never run out of money. Well, imagine trying to do that today when we're seeing these kind of negative events turbulence in the market. And how long is it going to last, and what are some things you can do? I'm going to share some strategies with you to how you can protect yourself and your income right after this break. Join me here. We'll be right back on the Retirement Report.